Let me ask you a question that sounds simple, but the answer is so weird that once you hear it, you'll never look at your bank the same again. What do you think happens to your money when you put it in a bank? Like, imagine you're 10 years old and you've got $100 from your birthday. You walk into a bank like a little responsible legend. You hand the teller your $100 and you're thinking, okay, cool, now my money is safe in the bank vault, right? Like a giant underground room with lasers, security guards, and a mountain of cash, and somewhere in the pile is a tiny envelope that says, this kid's $100, do not touch. That's what most people imagine. But here's the crazy part. That's not what happens. Not even close. In reality, when you deposit money into a bank, the bank does not take your money and safely store it like a treasure chest. The bank takes your money and uses it like fuel. Because banks are not really money storage buildings. They're money factories. And I know that sounds dramatic. So let's break it down in the simplest way possible. A bank is basically like a lemonade stand. Except instead of selling lemonade, it sells loans. The bank buys money from you for cheap, then sells that same money back to other people for expensive. That's how banks make money. If you deposit money, the bank might pay you interest like 0.5% or 1%. That's the bank basically saying, thanks for letting us borrow your money. Here's a tiny snack. Then the bank takes that money and lends it to someone else for 6%, 10%, sometimes even 20% if it's a credit card. So the bank pays you a tiny bit and charges other people a lot, and the difference between those two is profit. That part is pretty straightforward. But now we get into the part where things start feeling like a magic trick. Because banks don't just lend out your money, they lend out most of your money. And sometimes they lend money they don't even have. And yes, that is exactly as insane as it sounds. So let's talk about a concept that sounds boring, but it's secretly one of the most important and most suspicious things in the entire modern economy. It's called fractional reserve banking. Fractional reserve banking is basically the rule that banks only have to keep a fraction of deposits available as cash. Meaning if you deposit $100, the bank does not keep the full $100 in the vault waiting for you. The bank might only keep $10 and lend out the other $90. So in a weird way, the bank is doing what your friend does when you lend him money, except your friend doesn't have a license to do it. Because when you deposit money, your bank account says, you still have $100, but the bank has already handed $90 of it to someone else. So if you're 10 years old listening to this, you should be thinking, wait, hold up. How is that fair? What happens if I want my money back? Bingo. That exact moment, right there, is where the entire banking system starts to get spicy. Because if everyone came to the bank at the same time and said, give me my money, the bank would not have it. That's called a bank run. And it's basically the financial version of everyone trying to exit a movie theater through one tiny door. It gets chaotic fast. Now you're probably wondering, okay, if banks don't even have everyone's money, how do we not have bank runs every week? Because the government is basically standing behind the banks, like a big bouncer and saying, relax, everything's fine, nobody panic. In the United States, most banks are backed by something called the FDIC, which insures deposits up to $250,000. That insurance exists for one reason, because the system is built on trust. And if trust collapses, the system collapses. So when people say, banking is based on trust, they're not saying it like it's cute. They're saying it like, if people stop believing in the magic trick, the whole show ends. Now let's do a super simple example. Let's pretend you deposit $10,000. The bank keeps 10% as reserves, which is $1,000, and then lends out $9,000. Now here's the weird part. You still see $10,000 in your bank account. Meanwhile, someone else now has $9,000 in THEIR account after the loan. So how much money exists in total right now? It looks like there's $19,000 from one deposit. That's why people say banks create money, because the money multiplies through the lending system, even though no extra physical cash was printed. And if that sounds fake, it's because money is way more fake than most people realize. Now let's go one level deeper, because this is where it gets even crazier. Most people learn in school that deposits create loans, meaning banks need deposits so they can lend. That's the clean, polite version of the story. But listen closely, because here's the version nobody explains properly. In modern banking, it often works backwards. A lot of banks don't wait for deposits to lend. They lend first, and then they figure out the reserves later. So the more accurate sentence is, loans create deposits. When a bank approves a loan, it usually does not go into a vault and pull out a bag of money like it does Monopoly. Instead, it simply types the loan amount into your account. In other words, the money is born digitally. that money did not exist before the loan. It exists because the loan exists. And that is one of the most important truths about the modern economy. Debt creates money. So if you're watching this right now and you feel like you've been lied to your whole life, don't worry. You're not alone. Almost everyone thinks banks store money. But banks don't primarily store money. They create money and then charge you interest for using it, which is honestly one of the most genius hustles ever invented. Now at this point, you might be thinking, okay, so banks can just create money by lending. What stops them from creating infinite money and buying the entire planet? And why, yes, that is the correct question. Because if banks are allowed to create money just by typing it into existence, then the obvious question becomes, why don't they just do it all day long and become trillionaires overnight? What limits them? What stops them? And here's where it starts getting scary, because the things that limit banks aren't what you think. It's not morality. It's not fairness. It's not protecting you. It's basically the bank saying, if we lend too much, we might break the system, and then we don't get paid. So next, we're going to uncover the hidden truth behind your bank account that almost nobody understands until it's too late. Because the number in your bank app is not a pile of cash with your name on it. It's a promise. And that one little detail explains why, in a real financial crisis, the bank can legally lock you out, freeze withdrawals, or tell you to come back later. Yeah, that part. So watch closely. Because next is where the money explained like your 10 turns into O. This is why people don't trust banks. Alright, now that you understand the modern bank system, I want to take you back to the beginning. Because this is the part that makes everything click. When people hear banks create money, they imagine a bunch of rich guys in suits doing some secret ritual and whispering into a vault, and then cash magically appears. But the truth is actually more simple, more ridiculous, and honestly more suspicious. Modern banking is basically an upgraded version of an old scam that works so well. It became the foundation of civilization, and I'm not even joking. So let's rewind to a time before money as we know it. A long, long time ago, if you were a farmer and you needed a new tool, you would go to the tool maker and trade something for it. Maybe you traded food, maybe you traded cloth, maybe you traded labor. But what if you didn't have anything right then? Then the tool maker would say, fine, you can take the tool today, but you owe me later. That right there is the first form of credit. It wasn't a bank. It wasn't a loan contract. It wasn't a credit score. It was just trust. It was basically one human telling another human, I believe you will pay me later. And for a while, that worked. But then societies got bigger. People started trading with more people and more places for more things. You couldn't just carry around a bunch of chickens and sacks of grain every time you wanted to buy something. You pull up to the market like, hey sir, I'd like that shirt. And then you start unloading livestock out of your backpack. That doesn't scale. So humans did what humans always do when life gets complicated. They invented something smaller and easier to carry, money. At first, people used stuff that everybody agreed had value like salt, grain, cattle, and other valuable resources. The reason these things worked is because they were actually useful, and they weren't easy to get. That scarcity made them valuable. But eventually people settled on metals like gold and silver, because gold was strong, rare, and didn't rot. It didn't die. It didn't expire. It didn't get eaten by rats. Gold just sat there like, I'm gold. I'm chilling. So gold and silver became money. And for a while, that worked too. But there was one problem. Carrying gold everywhere is a nightmare. Gold is heavy, and if you're traveling long distances, it's also basically an invitation for robbery. Imagine you're walking through a dark street with a bag of gold coins. That's not money anymore. That's a please mug me sign. So people started needing a way to keep gold safe without physically dragging it everywhere. And this is where the plot twist happens. In 17th century London, people started leaving their gold with trusted goldsmiths. Goldsmiths were already known for working with valuable metals, so they had secure storage. People would deposit gold coins with them, and in exchange they'd get a written paper receipt. The receipt would basically say, this person has deposited 100 gold coins, and they can come redeem them whenever they want. So at first it was simple. Gold goes into storage. Paper receipt comes out. The paper wasn't money. It was just proof of ownership. But then humans did what humans always do. They got lazy. Instead of constantly going back to get the gold every time they wanted to buy something, people just started trading the paper receipts instead. Because if everyone trusted the goldsmith, then the paper was basically as good as gold. So the paper receipts became money. And this is where the goldsmiths realized something that changed history forever. Most people weren't actually coming back for their gold. The gold just sat there, which meant the goldsmith was sitting on a giant pile of gold, doing nothing with it, while people walked around using paper receipts like money. So the goldsmiths thought, wait a second, if only a few people ever come to withdraw their gold at the same time, what if we loan out extra paper receipts? And yes, that is exactly what happened. They started loaning out paper receipts that weren't backed by new gold. They just wrote extra receipts, fake promise notes, money that didn't technically exist. And as long as everyone didn't come demand gold all at once, nobody noticed. This is the original version of fractional reserve banking. This is literally the first version of money created out of thin air. Let's say a goldsmith had 1,000 gold coins locked up for customers. He could hand out paper receipts for 1,000 coins, and everything was fine. But then he got greedy. He started lending receipts for 200 more coins even though he didn't have the extra gold. Now suddenly, there were receipts for 200 coins floating around, even though only 1,000 coins existed. And the even crazier part is that it looked like the economy was growing because people had more money to spend. And because the receipts had to be repaid with interest, the goldsmith got richer. This is why banking became powerful fast. It wasn't because banks are nice. It's because banks realized they could profit by creating credit and collecting interest. So if you're wondering where the modern bank system came from, the answer is basically this. It came from goldsmiths figuring out that they could lend fake receipts and collect interest on money. That didn't exist. That's the origin. Now replace goldsmiths with banks. Replace paper receipts with digital numbers, and boom, you have the modern money system. Because today, banks don't store gold for you. They store numbers, and when they give out loans, they don't lose money the way most people think. They just create new money digitally, just like the goldsmiths created paper receipts. If you borrow money from a bank, the bank is not going into a vault and handing you a pile of cash. It's typing the money into your account. That money didn't exist before the loan. And when you pay the loan back, that money basically disappears again, like it gets deleted from the system. The bank keeps the interest as profit, but the created loan money itself gets canceled out. So money is constantly being created and destroyed inside the economy, based on loans being issued and loans being repaid. Which brings us to the biggest reason people feel like the system is creepy. Because if money is created through debt, then debt isn't optional. Debt is the engine. If banks stop making loans, money stops being created. And when money stops being created, businesses slow down, hiring slows down, and the economy starts feeling like it's suffocating. So the system becomes addicted to lending, like it needs new loans, just to stay alive. Now look at your life for a second. Look at credit cards. Look at mortgages. Look at car loans. Look at student loans. Look at buy now pay later apps. We live inside a world where everything is financed and almost everything is borrowed. That's not an accident. That is how the system keeps money flowing. Now you might be thinking, okay, but if banks create money by loans, where does the government fit into this? And that question is where things get ridiculous, because the government also needs money. And the way the government gets money is not how most people think. A lot of people think the government just prints unlimited money whenever it wants. But most of the time, the government creates money the same way the rest of the system does, by borrowing. And once you understand how government borrowing works, you'll finally understand why the country is always in debt, why taxes never feel like enough, and why the entire system feels like it's running on a credit card that nobody can ever pay off. So next we're going to talk about government bonds, the central bank, and how money gets created at the highest level. Because once you see that loop, you'll realize the whole economy isn't just a marketplace, it's a debt machine. Alright, now that you understand the modern bank system, I want to take you back to the beginning. Because this is the part that makes everything click. When people hear banks create money, they imagine a bunch of rich guys in suits doing some secret ritual and whispering into a vault, and then cash magically appears. But the truth is actually more simple, more ridiculous, and honestly more suspicious. Modern banking is basically an upgraded version of an old scam that works so well, it became the foundation of civilization. And I'm not even joking. So let's rewind to a time before money as we know it. A long, long time ago. If you were a farmer and you needed a new tool, you would go to the tool maker and trade something for it. Maybe you traded food, maybe you traded cloth, maybe you traded labor. But what if you didn't have anything right then? Then the tool maker would say, fine, you can take the tool today, but you owe me later. That right there is the first form of credit. It wasn't a bank. It wasn't a loan contract. It wasn't a credit score. It was just trust. It was basically one human telling another human, I believe you will pay me later. And for a while, that worked. But then societies got bigger. People started trading with more people, in more places, for more things. You couldn't just carry around a bunch of chickens and sacks of grain every time you wanted to buy something. You pull up to the market like, "Hey sir, I'd like that shirt." And then you start unloading livestock out of your backpack. That doesn't scale. So humans did what humans always do when life gets complicated. They invented something smaller and easier to carry: money. At first, people used stuff that everybody agreed had value, like salt, grain, cattle, and other valuable resources. The reason these things worked is because they were actually useful, and they weren't easy to get. That scarcity made them valuable. But eventually people settled on metals like gold and silver, because gold was strong, rare, and didn't rot. It didn't die. It didn't expire. It didn't get eaten by rats. Gold just sat there like, "I'm gold. I'm chilling." So gold and silver became money. And for a while, that worked too. But there was one problem. Carrying gold everywhere is a nightmare. Gold is heavy. And if you're traveling long distances, it's also basically an invitation for robbery. Imagine you're walking through a dark street with a bag of gold coins. That's not money anymore. That's a "please mug me" sign. So people started needing a way to keep gold safe without physically dragging it everywhere. And this is where the plot twist happens. In 17th century London, people started leaving their gold with trusted goldsmiths. Goldsmiths were already known for working with valuable metals, so they had secure storage. People would deposit gold coins with them, and in exchange they'd get a written paper receipt. The receipt would basically say, "This person has deposited 100 gold coins, and they can come redeem them whenever they want." So at first it was simple. Gold goes into storage. Paper receipt comes out. The paper wasn't money. It was just proof of ownership. But then humans did what humans always do. They got lazy. Instead of constantly going back to get the gold every time they wanted to buy something, people just started trading the paper receipts instead, because if everyone trusted the goldsmith, then the paper was basically as good as gold. So the paper receipts became money. And this is where the goldsmiths realized something that changed history forever. Most people weren't actually coming back for their gold. The gold just sat there, which meant the goldsmith was sitting on a giant pile of gold, doing nothing with it, while people walked around using paper receipts like money. So the goldsmith thought, wait a second, if only a few people ever come to withdraw their gold at the same time, what if we loan out extra paper receipts? And yes, that is exactly what happened. They started loaning out paper receipts that weren't backed by new gold. They just wrote extra receipts, fake promise notes, money that didn't technically exist. And as long as everyone didn't come demand gold all at once, nobody noticed. This is the original version of fractional reserve banking. This is literally the first version of money created out of thin air. Let's say a goldsmith had 1,000 gold coins locked up for customers. He could hand out paper receipts for 1,000 coins and everything was fine. But then he got greedy. He started lending receipts for 200 more coins even though he didn't have the extra gold. Now suddenly, there were receipts for 1,200 coins floating around, even though only 1,000 coins existed. And the even crazier part is that it looked like the economy was growing because people had more money to spend. And because the receipts had to be repaid with interest, the goldsmith got richer. This is why banking became powerful fast. It wasn't because banks are nice. It's because banks realized they could profit by creating credit and collecting interest. So if you're wondering where the modern bank system came from, the answer is basically this. It came from goldsmiths figuring out that they could lend fake receipts and collect interest on money that didn't exist. That's the origin. Now, replace goldsmiths with banks. Replace paper receipts with digital numbers, and boom. You have the modern money system. Because today, banks don't store gold for you. They store numbers. And when they give out loans, they don't lose money the way most people think. They just create new money digitally, just like the goldsmiths created paper receipts. If you borrow money from a bank, the bank is not going into a vault and handing you a pile of cash. It's typing the money into your account. That money didn't exist before the loan. And when you pay the loan back, that money basically disappears again. Like it gets deleted from the system. The bank keeps the interest as profit, but the created loan money itself gets canceled out. So money is constantly being created and destroyed inside the economy, based on loans being issued and loans being repaid. Which brings us to the biggest reason people feel like the system is creepy. Because if money is created through debt, then debt isn't optional, that is the engine. If banks stop making loans, money stops being created. And when money stops being created, businesses slow down, hiring slows down, and the economy starts feeling like it's suffocating. So the system becomes addicted to lending, like it needs new loans just to stay alive. Now look at your life for a second. Look at credit cards. Look at mortgages. Look at car loans. Look at student loans. Look at buy now, pay later apps. We live in a world where everything is financed and almost everything is borrowed. That's not an accident. That is how the system keeps money flowing. Now you might be thinking, okay, but if banks create money by loans, where does the government fit into this? And that question is where things get ridiculous. Because the government also needs money. And the way the government gets money is not how most people think. A lot of people think the government just prints unlimited money whenever it wants. But most of the time, the government creates money the same way the rest of the system does, by borrowing. And once you understand how government borrowing works, you'll finally understand why the country is always in debt, why taxes never feel like enough, and why the entire system feels like it's running on a credit card that nobody can ever pay off. So next we're going to talk about government bonds, the central bank, and how money gets created at the highest level. Because once you see that loop, you'll realize the whole economy isn't just a marketplace, it's a debt machine. Alright, now we're going to connect the final piece of the puzzle. Because once you understand this part, you'll realize why people keep saying the whole system feels like a rigged game. Here's the big question. If banks create money through loans, then how does the government get money when it wants to spend trillions? Because the government spends money on everything. Schools, roads, firefighters, healthcare programs, military, government workers, disaster relief, and a million other things. So, where does that money actually come from? Most people think the answer is simple. The government prints it. And yes, technically, physical cash is printed. There is literally a government facility running machines day and night, producing new bills to replace old ones and keep up with demand. But that physical cash is a tiny, tiny slice of the money in the system. Most money does not exist as paper. Most money exists as digital numbers. So, when the government creates money, what it's really doing is creating debt. And this is where it gets ridiculous. The main way the US government gets extra money is by issuing something called treasury bonds. A bond is basically an IOU from the government. It is the government saying, lend me money today, and I promise to pay you back later, plus interest. So instead of a bank lending money to you, it's your big institutions lending money to the government. And who buys these bonds? Big banks, corporations, pension funds, insurance companies, foreign governments, basically. All the giant players with massive amounts of money that want a safe return. So the government sells bonds, and that brings money into the government's budget. Then the government spends that money into the economy by paying contractors, employees, and companies. And that money flows into people's bank accounts. That sounds normal, right? Here's the problem. The government almost always spends more money than it collects in taxes. That means if taxes aren't enough to cover the budget, the government doesn't pause spending. Instead, it borrows more. So it issues more bonds, and more bonds, and more bonds, which means the government is constantly stacking debt on top of debt. Now this is the part people miss. When the government borrows money, it doesn't just borrow from some random pile of money. It borrows from the same financial system that banks sit inside of, which means government borrowing feeds the banks, and the banks feed the debt system back again. It becomes a loop. Government borrows, gives. Money enters economy, gives money, ends up in banks, gives banks, lend more. Gives more money exist, gives more debt exist, gives government borrows again. So, when someone says, why is the national debt always growing? The answer is not just bad leadership or wasteful spending. It's because the system is designed to operate that way. It runs on debt like a car runs on gasoline. Now, here's where it gets even crazier. There's a special institution that sits above the whole system and makes sure the machine keeps running even when things get ugly. That institution is the central bank. In the US, that is the Federal Reserve. And yes, this is the part where people start whispering the words money printer. Because the Federal Reserve has the ability to create new money digitally and inject it into the financial system. It doesn't do this by literally printing cash and throwing it from helicopters, like some cartoon villain. It does it by buying government bonds and other assets. So imagine the government issues bonds, but not enough investors want to buy them, or interest rates would have to go way too high. The Federal Reserve can step in and buy those bonds. When the Fed buys bonds, it creates new money to do it. It types it into existence. So the government gets funding, the financial system gets extra liquidity, and everything keeps moving. Now here's the uncomfortable truth. This kind of money creation isn't free. When more money enters the system, without more real goods being produced, prices rise, and that is inflation. That means your dollar buys less, groceries get more expensive, rent climbs, And people feel like they're running faster just to stay in place. That's why people get mad. Because it feels like your work becomes less valuable over time, while the system quietly expands itself from the top. Now I want you to listen closely, because this is where things start feeling like the system has two different sets of rules. When money is created through loans and government debt, the first people who benefit are the ones closest to the money creation process, which includes banks, large institutions, and asset owners. By the time that money reaches regular people, prices have already begun moving. That's why you see this weird reality where stock markets can soar, real estate can jump, and the financial world can look healthy, even while regular families feel like they're drowning. It's not because you're lazy. It's not because you're dumb. It's because the money system is built like a ladder, and the people at the top get the new money first. And if that sounds like a conspiracy, I get it. But it is also a pretty straightforward financial mechanism. Now here's the real question. If all of this money is being created through debt, then doesn't that mean the entire world is basically running on borrowed money? And if the entire world is running on borrowed money, what happens if the borrowing slows down? What happens if banks stop lending? If investors stop buying bonds? Or if the debt machine starts choking? That right there is when things get scary. Because if debt is the fuel, then credit freezes are the engine failure. So next we're going to talk about why the system always creates winners and losers, and why the people who control credit quietly control the future. Because once you understand that, you'll finally see how banks don't just make money, they shape society. Alright, now we're going to get into the part that makes people angry. Because this is where the whole system stops looking like a neutral money machine, and starts looking like a game where the rules were written by the people who already have money. Up until now we've talked about what banks do, how they lend out deposits, how loans can create deposits, and how governments fund themselves through debt by issuing bonds. All of that sounds like technical finance stuff, and it is. But the reason people get emotional about it is because of what it does to real life. It changes who gets ahead and who falls behind. Because the modern money system does not reward hard work first. It rewards proximity to credit first. And once you understand that, it becomes painfully obvious why banks always seem to win, even when the rest of the country is struggling. Let's start with the most important principle in the whole system. Credit controls money, and money controls what gets built. People think money is the power, but money is actually the result. The real power is the ability to create or access money cheaply, which means the ability to get loans at low interest and high amounts. That is why wealthy people and large corporations can scale so fast. Because they are not limited by saving money slowly like most regular people are. They can borrow millions or billions at favorable rates, buy assets, expand businesses, and then pay back the loans using income that the assets generate. That is a completely different universe compared to the average person, who has to work for money first, save what's left, and hope prices don't rise faster than their paycheck. So when someone says, the rich get richer, it's not just a motivational quote. It's a structural truth of a debt-based system. Now here's where it gets even more obvious. Let's say you're a regular person who wants to buy a house. You go to the bank, and they look at you like you're trying to borrow a spaceship. They want paperwork, tax returns, pay stubs, credit score history. And they want proof that you're not going to disappear into the desert with their money. But if you already own assets, if you already have money, if you already have connections, suddenly the bank treats you like royalty. Because banks don't lend based on who deserves money. Banks lend based on who is safest and most profitable. So the safest borrowers, people with assets, get the best rates. And the riskiest borrowers, people who are struggling, get the worst rates. That means the people who need help the most pay the most, while the people who need help the least pay the least. And if that sounds backwards, it's because it is. Now let me make this super simple with an example that even a 10-year-old could understand. Imagine two kids want to borrow $10. One kid already has $100 in his pocket, and the other kid has $0. Who do you think the bank will trust more? The kid who already has $100. So the kid who already has money gets the loan cheaper and easier, and the kid who has nothing gets rejected or charged a higher price. That is basically the whole system. It's like the money world saying, if you already have money, we'll help you get more money. If you don't, good luck. That is why the system produces inequality almost automatically, even without anyone needing to be evil. It is built into the math of lending and risk. Now, here's another reason banks always win. They don't just profit from the interest you pay them. They also profit from the fact that money itself is a moving target. Inflation makes money lose value over time, which means if you save cash, your cash slowly becomes weaker. But if you own assets, those assets can rise with inflation. So inflation punishes savers and rewards owners. This is why it feels like everything is getting more expensive. But the people who own real estate and stocks still seem fine. Because the system doesn't measure your life in effort. It measures your life in assets. Now let's talk about something even more sneaky. People think banks are powerful because they have money. But banks are powerful because they have influence over what the economy becomes. Banks decide what gets funded. Banks decide what grows. Banks decide what dies. If banks decide to stop lending to small businesses shrink. If banks decide to heavily fund luxury real estate projects, luxury real estate grows. If banks decide to pour credit into tech explodes. If they stop, tech collapses. That means banks aren't just participating in the economy. They are shaping the economy like sculptors. And here's the craziest part. You don't even notice it, because it's hidden behind normal boring words like credit markets, risk, and monetary policy. But in reality, this is one of the most powerful forces in human society. Now think about the last few decades. Think about how the world feels like it's becoming more expensive and more debt-based. Credit cards became normal. Car loans became normal. Student loans became normal. Mortgages became normal. Even buying furniture became a normal way to finance. Even buying a sandwich became normal to finance. Now we've got buy now, pay later apps turning people into monthly payment zombies. That didn't happen randomly. That happened because the system is designed to turn more things into debt. Because debt is the pipeline that creates money and creates profit. So the system expands by turning your life into a subscription. And yes, that sounds dramatic. But look around. People are literally financing groceries and rent. That's not normal. That is a society gasping for air. Now here's the point where the conspiracy vibe gets real. If the entire system depends on debt expansion, then the biggest fear for the people in power is not inflation. It's deflation. It's credit shrinking. Because if lending slows down, money stops being created as fast. That means business activity slows down. People stop hiring, people stop spending, and the system starts freezing. That's why whenever we get near a major recession, governments and central banks panic and inject money into the system. They cut interest rates, they stimulate spending, and they do whatever they can to keep credit flowing. Because the modern system cannot handle full stop. It is like a bicycle that has to keep moving or it falls over. Now here's the part you have to think about. If banks can create money by lending, and governments can create money by borrowing, then who really owns the future? The people who control credit. Because if you control credit, you control who gets money first, what grows, and what survives. And that is why banks always seem untouchable. That is why banks can gamble, overextend, and still survive. Because when banks fail, the government doesn't just say, oh well. When banks fail, the whole system fails, because banks are the pipes that money flows through. So the system protects them. Because if it doesn't, the system collapses. Now I want you to hold on to that thought. Because in the next part, we're going to talk about what happens when the system gets overloaded, and why every few years it seems like there's a crisis, a bailout, and a new emergency policy that makes the rich richer, while everyone else gets a lecture about budgeting. And once you understand that cycle, you'll realize something that feels almost too crazy to say out loud. Banks don't just make money, they make the rules, and most people don't even know they're playing. Now we are going to talk about the part of the banking system that makes normal people feel like they're living inside a rigged board game, because once you spot the pattern, you will start noticing it everywhere, and it becomes impossible to unsee. The pattern is simple. When regular people mess up financially, the consequences are immediate and brutal. But when banks mess up financially, the consequences are too dangerous for the system to allow. So instead of punishment, they get rescue. Think about it like this. If a regular person misses a few payments, they do not get a press conference, a bailout program, or an emergency rescue package from the government. They get late fees, penalties, interest spikes, and eventually they get their car repossessed or their credit score destroyed. And then the world looks at them like, well, you should have been responsible. But if a major bank makes reckless decisions, overextends itself, and takes giant risks that explode, the system reacts as if someone just threatened to shut off oxygen to the entire country. And the reason that happens is not because the system loves banks as people, or because bankers are the heroes of society, or because anyone is secretly emotionally attached to Morgan Chase. The reason it happens is because banks are the plumbing system of the economy. And if you blow up the plumbing system, everything else collapses with it. When banks fail in a way that spreads across the system, paychecks do not clear, businesses cannot borrow, trade slows down, and suddenly the economy starts suffocating. This is why the system is designed to save banks first, not because it is morally correct, but because the alternative is chaos. And governments tend to choose boring stability over total collapse, even when stability feels unfair. So yes, it can feel like banks are treated like royalty. But the deeper truth is that banks are treated like the electrical grid, because if the grid goes down, everybody suffers. Now let's talk about how these crises actually happen, because this is the part that will make you realize that financial disasters are not random events. They are often the predictable result of the same machine running too hot for too long. Remember what we said earlier. In the modern system, most money is created through lending, meaning loans are not just a side activity of banks, but are actually the main pipeline through which new money enters the economy. So, when banks are feeling confident and interest rates are low, banks lend more aggressively, businesses borrow more aggressively, and regular people borrow more aggressively, and the entire economy starts to feel like it is booming. That boom feels good because money is flowing, jobs are rising, spending is rising, and asset prices rise, which makes people feel richer even if they did nothing except own a house or have a retirement account. The problem is that credit-fueled booms do not just create growth, they also create bubbles. Because when credit expands too quickly, it inflates asset values beyond what the real economy can support. Housing is the easiest example to understand, because when banks make mortgages easy and interest rates are low, more people qualify for larger loans, and that larger borrowing power turns into higher bidding power, which pushes housing prices upward. Once housing prices rise, people start believing they will rise forever. And once people believe that, they behave differently, because they stop treating homes like shelter and start treating homes like investments. That is when the bubble starts turning into a monster. Because investors pile in, people flip houses, banks create more mortgages, and the entire market becomes addicted to the idea that prices can only go up. At that stage, you are no longer dealing with normal economics, you are dealing with mass psychology powered by cheap debt. Now here is the key detail that most people never learn until they experience it the hard way. When loans are issued, money is created. But when lending slows down, money creation slows down. And when lending collapses, money creation can suddenly dry up. The economy does not just slow down because people get nervous. It slows down because the money supply stops expanding the way it normally does through loans. This is why credit booms feel like sunshine and credit contractions feel like winter. Because the same machine that creates money through lending also pulls the brakes. When banks get scared, they tighten lending standards, meaning fewer people qualify for loans, fewer businesses can expand, fewer projects get funded, fewer houses get bought, fewer jobs get created, and suddenly everything starts feeling like it is shrinking. This can be especially brutal because in a debt-based system, debt is not only what powers growth, but it is also what powers confidence. Because people make decisions based on the assumption that money will keep flowing. Once that assumption breaks, people panic, and when people panic, they do the one thing that a fractional reserve system absolutely hates. They try to pull out cash and demand safety. This is why in major crises, central banks and governments jump in so fast. Because they know that fear spreads quicker than math. Central banks lower interest rates to encourage borrowing. They offer emergency lending facilities to banks. And sometimes they buy assets or government bonds to inject liquidity into the system. Because if the money pipes freeze, the economy starts choking. This is not done because it is fair, and it is not done because it rewards good behavior. It is done because the modern economy has been designed to run on a continuous flow of credit, and when credit stops, the engine stalls. Now here is where people get furious, and honestly I understand why. When these rescues happen, the money often flows first into financial institutions, financial markets, and asset systems, which can cause stocks to recover faster than people's lives recover. So the average person might be watching their rent rise, their groceries rise, and their wages crawl slowly, while at the same time they hear headlines about markets bouncing back, billionaires gaining wealth, and big institutions being stabilized. And it feels like watching the rich get a safety net while everyone else gets a lecture. That is why public trust gets so fragile during these periods. Because the system sends mixed messages. On one hand, it claims everyone must be responsible. On the other hand, it shows that when the stakes get big enough, responsibility gets replaced by emergency protection. Because the system chooses survival over fairness. And if you want the edgy truth, the system does not prioritize you. The system prioritizes the flow of money. Because that flow keeps society functioning, even if it feels unfair. Your well-being matters, but it matters less than the stability of the machine. Because the machine supports everyone, even while it favors certain people more than others. Now let's bring this back to the biggest question that actually matters to the viewer watching this video. If the system is designed this way, and if it repeats these boom and bust cycles like a heartbeat, then how are regular people supposed to survive inside it, without being crushed every time the machine swings from greed to fear? That is what we are going to talk about next. Because the goal of this video is not to make you paranoid or depressed. The goal is to make you aware. Because the moment you understand the rules, you stop being emotionally manipulated by headlines. And you stop being surprised when the system behaves exactly the way it was designed to behave. So next we are going to talk about what banks quietly want you to believe, what the real survival rules are in a debt-based economy, and how regular people can stop playing the money game like victims and start playing it like informed adults. Now that you understand how the machine works, we need to talk about what actually matters. Because knowing how banks create money is interesting, but using that knowledge to protect yourself is where this video becomes powerful. The entire money system is like a game where the rules are never explained to most people, and then everyone wonders why they keep losing. The harsh truth is that people are not failing because they are dumb or lazy. A lot of people are failing because they were never taught the rules that the system rewards. So let's talk about those rules in a way that makes sense, especially if you are trying to survive in a world where money is created through debt, banks profit through interest, and governments keep the whole machine running by injecting more credit whenever the engine starts choking. The first survival rule is something that sounds obvious, but most people do not live it. You have to understand the difference between money and wealth. Money is what you use to pay bills, but wealth is what you own that holds value over time. If you only focus on money, you will feel like you are sprinting on a treadmill forever. Because money loses purchasing power over time due to inflation, meaning the same dollars buy less every year. That is why you can work harder than ever and still feel like you are falling behind. Because in a system where the money supply expands constantly, cash is not a stable store of value. Wealth is different because wealth usually means ownership, and ownership is what the system protects. This is why people who own assets often feel like they live in a different universe than people who only live paycheck to paycheck. Asset owners can benefit from inflation because inflation pushes up the price of real things, like real estate, stocks, and businesses, while cash becomes weaker. So when someone says, inflation is making everything expensive, what they are really saying is, inflation is punishing people who hold cash while rewarding people who hold assets. That is not always fair, but it is the reality of the system. The second survival rule is that debt is not always evil, but consumer debt is a trap. A lot of people hear debt-based money system and assume that all debt is bad. That is not completely true. Debt is a tool, and like any tool, it can be used to build a house or it can be used to break your own foot. The problem is that modern society pushes people into the worst type of debt, which is debt that buys things that lose value and do not generate income. Credit card debt is the clearest example, because credit card debt is usually expensive debt, and it is often used for survival spending or for lifestyle spending. That means people are paying 20% interest on things that are already gone by the time the bill arrives. That is why credit cards can feel like quicksand, because the interest is designed to keep you paying for the past while you are trying to afford the present. Now compare that to a business loan that generates income, or even a mortgage that buys you an asset that might rise over time. Those debts can still be risky, but at least they are attached to something that can create value or hold value. Consumer debt is different because it turns everyday life into a subscription service, where you are permanently renting your own decisions from the bank. This is why one of the smartest things you can do is stop letting the system convert your wants into loans, because the system is always trying to turn your desires into interest payments. It is not your friend. It is a business model. The third survival rule is that your financial life becomes easier when you stop thinking like a worker and start thinking like an owner. I am not saying everyone needs to start a corporation tomorrow or become a millionaire overnight, because that is unrealistic and honestly annoying. What I am saying is that the system is structured to reward ownership. So the long-term goal should always be to own something valuable, even if you start small. It could be owning a portion of a business, even a tiny one. It could be owning investments, even if it is only a little each month. It could be owning a skill that gives you leverage and higher income. Ownership is what gives you bargaining power in a system that expands money supply through debt, because ownership allows you to participate in the upside of inflation rather than only suffering the downside. Now, here is the uncomfortable part. Banks and financial institutions want people to stay in the worker-only mindset, because workers are predictable. Workers are easy to score, easy to lend to, and easy to profit from. Workers are also the perfect customers for interest payments because they have income streams that can be tapped for loans. This is why the system constantly markets loans as lifestyle upgrades. It is not really selling you a car. It is selling you a monthly payment. It is not really selling you furniture. It is selling you financing. It is not really selling you education. It is selling you a debt contract. Once you see that, you stop getting fooled. by marketing language, and you start realizing that the real product being sold is you. The fourth survival rule is that you cannot outsource your understanding of money to the same system that profits from your confusion. This is one of the biggest traps in modern life. People say things like, "I'm not good with money," or "I'll just let the professionals handle it," without realizing that many professionals are not paid to maximize your outcome. They are paid to sell products. That does not mean every banker or financial advisor is evil, but it does mean the incentives are not always aligned with you. If you do not understand how the system makes money, you become the raw material that makes money for others. That is why the entire point of this channel is to explain the system in a way that makes you harder to manipulate. Now, the fifth survival rule is one of the most important and also one of the most ignored. When the system is unstable, liquidity becomes power. This is the part that most people learn too late. When times are good, being fully invested and fully leveraged can feel smart, but when times turn bad, the people who can survive are the people who have breathing room. That breathing room can be emergency savings, low debt, stable income, flexible skills, and the ability to adapt. In a crisis, the people who have liquidity can buy assets at discounts, start new opportunities, and survive when others are forced to sell. This is why crises can widen inequality, because in the crash, the people with stability buy cheap, and the people without stability sell low. So if you want to play the system intelligently, you have to treat stability as an asset, not as a boring afterthought. Now I want to be clear, because this is not a blame the victim speech. The system is unfair in many ways, and a lot of people are genuinely trapped. But the reason we are talking about survival rules is because awareness gives you options, and options give you power. When you understand the cycle, you stop being emotionally shocked every time it repeats, and instead you start preparing for it like it is predictable weather. Because here is the truth. This machine will keep cycling. It will keep swinging between boom and bust, greed and fear, cheap money and expensive money. That is not a rare event. It is the rhythm of a debt-based system. Now that you understand the survival rules, the next question is the one that really matters. And it is the question that makes this entire topic feel like a conspiracy hiding in plain sight. If banks can create money, and governments can create money through debt, then who truly controls the money system at the highest level? Who sits at the top of this entire pyramid and decides when money gets easier, when money gets tighter, and when the public has to suffer? That is what we are going to talk about next. Because once you understand central banking power, you will realize that money policy is not just economics, it is a form of control. Now we are going to talk about the part of the money system that makes even normal, reasonable people start sounding like conspiracy theorists at the Thanksgiving table. Because the deeper you go into this topic, the more you realize that the biggest power in society is not always politicians, and it is not always laws, and it is not even always who has the most money. The biggest power is who controls the flow of money itself, because the flow of money is what decides whether the economy feels easy or painful, whether businesses expand or collapse, whether people can afford homes or get priced out, and whether a country feels stable or chaotic. Most people spend their lives thinking that money is just something you earn, save, and spend. But in reality, money is also a tool of national strategy, a tool of economic control, and sometimes even a weapon. That is why understanding who controls the money system matters more than understanding almost any other finance topic. Because if you know who controls the money, you know who controls the rules of your life without ever needing to vote on it. So let us talk about the group that sits in the center of modern money creation and modern money control: central banks. In the United States, the central bank system is called the Federal Reserve. And it has a strange reputation because depending on who you ask, it is either a boring, technocratic institution made of economists and spreadsheets, or it is the shadow boss of the entire country that quietly decides who wins and who loses. The truth is not as dramatic as the internet makes it sound, but it is also not as innocent as most textbooks make it sound, because the Federal Reserve has the power to reshape your entire financial reality using just a few decisions. The easiest way to understand the Federal Reserve is to think of it like the thermostat of the economy. When the Fed lowers interest rates, money becomes easier to borrow, loans become cheaper, businesses expand more easily, and people can buy bigger things like houses and cars with less pain. When the Fed raises interest rates, borrowing becomes harder, loans become more expensive, businesses slow down, and people have to cut spending because the cost of money itself has become heavier. So the Fed has the ability to make the entire economy feel warm and comfortable, or cold and brutal. And that makes it one of the most powerful institutions in society. Because the economy is where real life happens. It is where jobs happen, bills happen, rent happens, food happens, and survival happens. Now, here is the part that gets interesting. The Fed does not directly control your paycheck, and it does not directly control the price of your groceries, but it controls the environment where those prices and paychecks form. It controls the conditions under which money is created and destroyed, because when banks lend, money is created, and when banks stop lending, money creation dries up. That means the Fed's biggest influence is not that it prints money like a cartoon. It influences how aggressive or how cautious banks and markets become. When you hear the phrase monetary policy, it sounds like something that should be in a boring textbook next to the definition of GDP. But monetary policy is basically the power to decide how hard life is financially for millions of people. And the scariest part is that most people do not realize they are living under that system until they feel it in their rent, their loan payments, and their job security. Now, a normal person might reasonably ask, okay, why does the Fed even exist? And why does one institution get this much power? The simple answer is that central banks were created because fractional reserve banking and debt-based money systems are unstable, meaning they naturally create cycles of booms and crashes, and governments needed a stabilizing force that could add money into the system during panic and tighten the system during overheated speculation. In theory, that sounds responsible, because it is like having a fire department in a city that has a lot of buildings made of wood. But the reason people get suspicious is that the fire department also controls the matches. When the Fed cuts interest rates for a long time, it can inflate asset bubbles and encourage reckless borrowing. And when the Fed raises interest rates quickly, it can crush borrowers and cause job losses. So whether intentionally or not, the Fed's actions can create huge winners and huge losers. And those winners and losers are not always evenly distributed. This is why central banking gets political even though it pretends not to be political. Because raising rates hurts people with debt while helping people who already have capital. And cutting rates helps borrowers while inflating asset prices and rewarding those who already own assets. No matter what the Fed does, someone wins and someone loses. And if you are not paying attention, you might spend your whole life on the losing side without even knowing why now. This is where the invisible government feeling comes from. Most people assume that the government controls the economy directly, but in reality, the central bank often has enough power to override the emotional desires of politicians and the public. Because central banks are usually designed to be somewhat independent. That independence exists for a reason. Because politicians are tempted to juice the economy in the short term, especially before elections. But independence also creates a creepy reality where one of the most important forces shaping society is not directly accountable in the same way elected officials are. To a regular person, that can feel like this. You can vote for different leaders. You can argue online. You can protest. You can complain. You can do all the normal democratic stuff. But if interest rates rise from 3% to 7%, your entire life can change regardless of who you voted for. Your mortgage can become impossible. Your rent can rise. Your car payment can hurt more. And suddenly your financial future feels smaller. And it happened not because of something you did, but because the environment changed. That is why people get emotionally intense about central banks. Because it feels like someone is controlling the difficulty setting of life. Now, we have to talk about the part everyone jokes about, the money printer. When people say the Fed prints money, they are usually referring to policies where the Fed buys assets, often government bonds, to inject liquidity into the system. You can think of it as the Fed creating digital money and using it to purchase financial assets, which pushes money into banks and markets, making the system more liquid and lowering interest rates indirectly. During big crises, this process can go into turbo mode, because the Fed is trying to stop the entire system from freezing. The reason this is controversial is because the first place that money tends to flow is not your wallet. The first place it tends to flow is financial markets, because banks, institutions, and asset holders are closest to the pipeline. That can make it look like the system is designed to protect investors first, while regular people are told to wait it out and be responsible. This is why a lot of people lose trust, because they look at the system and think, when I struggle, it's my fault. But when the financial system struggles, it's everyone's problem. And they're not completely wrong. Now, here is the retention twist that most people do not see coming. Even if you believe the Fed is acting with good intentions, the structure of the system still creates the same outcome. Money control becomes centralized, and centralized money control creates centralized power. That is not a political opinion. It is just how control works. Because if one institution can influence interest rates, credit expansion, liquidity, and economic cycles, that institution becomes one of the highest leverage points in the country. So even if there is no secret club meeting, where bankers rub their hands together like cartoon villains, the result still feels like a quiet form of financial governance. Because decisions are being made that reshape society without direct public debate. That is why people call central banks the fourth branch of government, even if the phrase sounds dramatic. Now, at this point in the video, you might be thinking something even deeper. If the money system is controlled by central banks, and central banks influence money creation, then how does the US dollar become powerful enough to dominate the entire world? Why does everyone care so much about the dollar? And why does it feel like the US can borrow infinite money without collapsing like other countries? That question is where this story gets global, because this is not just about banks and loans anymore. This is about geopolitics, power, and the most important financial advantage the United States ever gained, the ability to make the world need its currency. So next we are going to talk about the dollar system, why global trade depends on it, and why certain countries are trying to escape it. Because once you understand that part, you will realize the US dollar is not just money, it is an empire tool. Now we are going to zoom out from banks and central banks and talk about the bigger game. Because once you understand how the US dollar became the center of global trade, you will realize that the world economy is not just countries buying stuff from each other. The world economy is also a competition for control. And the most powerful weapon in that competition is not missiles or tanks. It is the currency everyone needs. The reason people call the US dollar the world's reserve currency is because it is not just used inside the United States. It is used everywhere. Countries hold dollars. Companies trade in dollars. Global commodities get priced in dollars. Banks settle transactions in dollars. In many parts of the world, people even save in dollars because they trust the dollar more than their own local currency. So if you are wondering why the US seems to have financial advantages that other countries do not have, this is one of the biggest reasons. The US dollar is not just America's money. It is the world's money. Now let's explain this in a simple way. Like you are 10 years old. Imagine your school has a trading system where kids swap snacks and toys. But one kid's tokens are the tokens everybody trusts. Maybe his dad owns the store down the street. Or maybe he always has the good stuff. Or maybe everyone just believes his tokens will always work. If everyone uses that kid's tokens to trade, then that kid has a massive advantage. Because he can create tokens, and the whole school treats them like they are valuable. That is basically what happened with the dollar. Except instead of a school, it is the planet. And instead of snacks, it is oil, food, metals, shipping routes, and national power. So, how did the dollar become that token? A big piece of the answer goes back to the period after World War II. After the war, the US was in a unique position because much of Europe and Asia were damaged. While the US economy was strong and industrial capacity was huge, the United States also held a large portion of the world's gold reserves. And the world needed a stable system to rebuild global trade. That led to agreements that basically made the dollar the center of global finance. In the early system, dollars were linked to gold at a fixed rate, meaning countries could trust dollars because they were tied to something physical. That made the dollar attractive as a stable anchor for trade. But then history did what history always does, and the system started cracking. As the world grew and trade expanded, the US started spending more and running larger deficits, which meant more dollars flowed into the world. Eventually, the world began demanding gold in exchange for dollars, because technically, that was the deal. The US could not keep up forever, and that is where the original gold link system broke. When the US ended gold convertibility, it changed the nature of money permanently because the dollar was no longer backed by gold in the direct way people understood. If you are thinking, that sounds like a risky move, you are correct, and a lot of people thought it would destroy confidence in the dollar. But here is the twist. Instead of collapsing, the dollar became even more powerful. Why? Because the world still needed it. And this is where we talk about the most important word in global finance, oil. Oil is not just a commodity. It is the bloodstream of industrial civilization. Oil powers transportation, manufacturing, agriculture, and military logistics. Without oil, modern life starts malfunctioning fast. So whoever controls oil trade and oil pricing controls a huge part of global economic power. The dollar became deeply linked to oil trade, and that link is what people often describe as the petrodollar system. The idea, simplified, is that oil gets priced and traded mainly in dollars, meaning countries that want oil need dollars. When countries need dollars, they hold dollars, they trade in dollars, and they keep dollars in reserve. So the US created a situation where the world's most important commodity was largely traded in its currency. That is not just an economic advantage. That is a geopolitical advantage. Because if the world needs your currency to function, demand for your currency stays high. That demand supports your ability to borrow, supports your financial system, and supports your influence. Now, here is the part that will make you understand why people say the US can export inflation. if the US creates more dollars through debt and money expansion, those dollars spread around the global system because global trade needs dollars. That means some of the inflation pressure does not stay trapped inside the US. It spreads outward. Other countries absorb dollars because they need them. So the world's demand for dollars can act like a sponge that soaks up US money creation. This is one reason the US has been able to run huge deficits without immediately collapsing like other countries, because when other countries print money too aggressively, their currency collapses because no one outside wants it. But when the US expands its money supply, global demand for dollars can help absorb that expansion. That is why people say the US has a privilege in the money system. It can borrow more cheaply than other countries, it can run larger deficits, and it can survive in ways that would destroy smaller nations. Now here's where the global tension starts. If you are a rival power, or even just a country that wants more independence, being dependent on the US dollar is dangerous. It means your economy is exposed to US interest rate decisions. It means your trade is exposed to US controlled financial pipelines. It means if you get sanctioned or blocked, your access to global finance can be cut off. And sanctions are a huge part of this story, because sanctions are basically the currency system being used like a weapon. If you get locked out of dollar systems, if you get blocked from dollar settlement networks, it becomes extremely hard to do global trade, because banks and companies do not want to touch your transactions. That is why some countries are terrified of being too dependent on the dollar. This is why you are now hearing about BRICS, de-dollarization, alternative settlement systems, and countries trying to trade in their own currencies rather than dollars. This is not just an economic trend. It is a power struggle. It is countries trying to escape the gravity of the dollar, because living under the dollar system means living under U.S. influence global finance. Now, here is the important nuance, because this is where a lot of people oversimplify it. This does not mean the dollar is about to collapse tomorrow, and it does not mean the US is about to lose instantly. The dollar system is deeply entrenched, and it has powerful advantages like trust, stability compared to many currencies, deep financial markets, and global infrastructure. People do not switch reserve currencies overnight, like they are changing their phone wallpaper. But it does mean the world is changing. And the more global power shifts, the more financial alliances shift, and the more countries experiment with alternatives, the more the money system becomes politically charged now. The reason this matters is because when global demand for dollars shifts, it can change everything about US power, US borrowing cost, inflation dynamics, and the stability of the entire debt machine we talked about earlier. So the real question becomes this: what happens to America's debt-based system if the world starts needing fewer dollars? Because if global demand for dollars weakens, then US money creation becomes harder to absorb, and the consequences could be massive. That is the next part of the story, because once we talk about de-dollarization and what it could mean, you will understand why some people believe we are heading toward a major financial reset, and why governments around the world are quietly preparing for a future where money rules are changing. So next we are going to talk about what de-dollarization actually is, what BRICS is trying to do, what people get wrong about it, and why the fight over global currency might be one of the biggest battles of the next decade. Now let's talk about a word that keeps popping up more and more online, and every time it pops up, it makes people either roll their eyes or panic like the world is ending tomorrow. That word is de-dollarization. And depending on who you ask, de-dollarization is either the beginning of the end for the US dollar, or it is the most overhyped financial buzzword since crypto will replace banks. The truth is somewhere in the middle, and it is actually way more interesting than the dramatic headlines make it sound. De-dollarization simply means countries are trying to reduce their dependence on the US dollar for trade, savings, and global financial transactions. It is like if the world has been using one giant financial highway for decades, and now some countries are building side roads because they do not want to depend on the same highway that America controls. And yes, control is the key word here, because the reason the dollar is so powerful is not only because it is trusted, but because it is deeply built into global trade, oil, shipping, international banking settlements, global lending, and reserves are all connected to dollar systems. That means the US dollar is not just a currency, it is a global financial operating system. So if you are a country that doesn't always get along with the United States, being dependent on the dollar is risky. It means your economy can be influenced by US interest rate decisions, and it means your access to global financial pipes can be restricted if you fall into political conflict. This is why de-dollarization is not just about economics, it's about power, sovereignty, and survival. Because imagine you are a country, and you suddenly realize, wait, almost all global trade runs through the currency of a country that might sanction us. That is like realizing your enemy controls your debit card. Now you understand why some countries are trying to build alternatives. This is where groups like BRICS come into the conversation. BRICS is made up of large emerging economies, and over the years the group has gained more attention because it represents a growing chunk of world population, trade, and production. Now, not everything you hear about BRICS is accurate because the internet loves exaggeration, but there is still a real trend happening. Some countries are experimenting with trading in their own currencies instead of using dollars. Some countries are creating direct currency swap agreements. Some countries are building new payment systems. Some countries are increasing gold reserves. Others are pushing for multi-currency trade frameworks. Basically, they are trying to create a world where dollar dominance is reduced. Now here's the part where things get really important, because this is where most people misunderstand what de-dollarization means. De-dollarization does not mean the US dollar disappears. It does not mean America becomes poor overnight. It does not mean you wake up tomorrow and your dollars turn into monopoly money. The dollar is still powerful because the system has decades of infrastructure built into it. The U.S. has massive financial markets, huge bond markets, global business trust, and a currency that is still widely used as the safe place during crisis. That kind of dominance is sticky, and it does not evaporate quickly. However, what de-dollarization can mean is that the world starts reducing its automatic demand for dollars. Over time, it is not a light switch. It is more like water pressure slowly decreasing. And here is why that matters. America has been able to borrow enormous amounts of money partly because demand for dollars stays high around the world. That demand supports the dollar, supports treasury bonds, and supports America's ability to run deficits while still finding buyers for government debt. So the big question becomes, what happens if global demand for dollars weakens? Because if fewer people need dollars, fewer people hold dollars. If fewer people hold dollars, the world is less willing to absorb America's debt-based money expansion. And if the world is less willing to absorb it, then the US could face higher borrowing costs, more inflation pressure, and a harder time sustaining the same financial lifestyle it has enjoyed for decades. And this is why some people believe we could be heading toward a kind of global financial restructuring. They call it a reset, a realignment, or sometimes the dramatic phrase, the end of the petrodollar era. Now, let's be real. The world has been predicting the end of the dollar forever, and the dollar keeps surviving like a movie villain that refuses to die. So I am not here to tell you the dollar collapses tomorrow, but I am here to tell you that the world is clearly trying to create more options, because the last decade has shown countries that the dollar system can be used as a weapon, and no one wants to stay trapped inside a system where the rules can be changed by someone else. Now let's talk about the gold angle, because you hear gold brought up constantly in these conversations, and there's a reason. Gold is basically the international I don't trust you asset. When countries don't trust currencies, they buy gold. When countries don't trust stability, they buy gold. When countries think inflation is coming, they buy gold. When countries want a neutral reserve that no one can sanction directly, they buy gold. So if you see countries increasing their gold reserves, that does not automatically mean a reset is coming tomorrow. But it does suggest that some countries are preparing for a more unstable global currency world, where trust becomes harder and alliances become more fragile. And now we arrive at the uncomfortable conspiracy-flavored question. If the world starts shifting away from dollar dependence, and the US has to finance its system with less global demand supporting it, then where does the pressure go? Because it has to go somewhere. It can go into higher interest rates. It can go into more inflation. It can go into bigger taxes. It can go into reduced spending. It can go into debt monetization through central bank intervention. Or it can go into something even scarier, a slow decline where living standards quietly shrink. And most people don't understand why. That is the real reason de-dollarization matters, because it is not about headlines. It is about what happens when the world stops funding the same game at the same level. So next, we are going to talk about what a reset actually means in real-life terms. What would have to happen for the dollar system to truly lose dominance, and what signs people should watch that indicate the money game is changing. Because once you see those signs, you will realize that the biggest financial shifts do not happen with fireworks and dramatic announcements. They happen slowly. Alright, now we need to talk about the phrase that gets people either extremely excited or extremely paranoid, because it sounds like something out of a secret government meeting. That phrase is financial reset. Online, people talk about a reset like it is going to be one dramatic event where the old system dies overnight and a new system is installed like a phone update. They imagine some massive announcement, a global emergency broadcast, banks shutting down, and then everybody waking up to a new currency. But the truth is usually way more boring and honestly way more dangerous. Because the biggest resets in history rarely feel like one single day. They usually feel like a slow grind where normal people keep saying, "Why does life feel harder than it used to?" Until one day, the new reality is already here. So, when people say reset, what they are really talking about is a change in the rules of money, debt, and trust. And if you want the simplest explanation, here it is. A reset happens when the current debt system becomes too heavy to carry. Because remember what we said earlier, money enters the system through debt. And the more debt there is, the more interest payments there are. And the more the system needs growth to keep up. Eventually you reach a point where the debt pile becomes so large that the system can only survive. If it keeps expanding forever, that sounds fine if the world is stable and growth is guaranteed. But growth is not guaranteed. Societies hit limits, demographics change, wars happen, supply chains break, trust collapses, productivity slows down. When those things happen, the debt machines start straining. And the question becomes, how do you keep a debt-based money system alive? When the debt is too heavy, that is where resets come in. Now here is the important part, because most people misunderstand what a reset looks like. A reset is often not they delete the debt. A reset is more often they change the value of the money that debt is measured in. That is a fancy way of saying that the system can lighten the debt burden by making the currency weaker over time. Because if the currency is worth less, then debt is easier to pay back in cheaper dollars. This is one reason inflation is so controversial. Inflation hurts regular people because the price of life goes up. But inflation can quietly benefit large debt holders, including governments, because it reduces the real weight of what they owe. So one version of a reset is basically a slow burn where money loses purchasing power year after year, and people keep adjusting their lives downward without realizing it was a systemic strategy. Now let's talk about another version of a reset, changing who funds the system. If global demand for dollars shifts, if the world needs fewer dollars, or if foreign buyers start buying fewer U.S. bonds, America has to find other ways to finance spending. That could mean higher interest rates to attract buyers, higher taxes, reduced spending, or larger central bank intervention where money is created to support bond markets. Each of those paths has consequences, and none of them feel good for normal people. Higher rates make borrowing harder. Higher taxes reduce take-home pay. Reduced spending can reduce services. More money creation can raise inflation pressure. So when you hear people talk about a reset, it often means a point where the system cannot keep running on the old settings, and new settings are forced into place now. Here is the reason this topic gets even scarier. Resets often happen right after crises, because in normal times, people would reject new restrictions or big changes, but during a crisis, people accept things they would normally never accept, because fear makes people choose security over freedom. That is why financial crises are so powerful politically, because they give governments and institutions the excuse to make emergency changes. And emergency changes have a habit of becoming permanent. Now here's a key detail that most conspiracy videos leave out. It is extremely difficult to replace the dollar system overnight, because the world is built on it. Global shipping, trade finance, commodity markets, banking settlements, and reserves are deeply connected to dollar infrastructure. That means the most realistic reset is not the dollar is gone, but the dollar slowly becomes one major currency among several, while more trade happens in alternative currencies and networks. That kind of change would not feel dramatic day to day, but over 10 years it could be huge. Now let's get practical, because I know some people watching are thinking, okay, if a reset is possible, what sign should we watch for? The first sign is rising stress in bond markets, because the bond market is basically the backbone of government finance. If the government struggles to sell debt without paying higher yields, that is pressure. If central banks step in more aggressively to stabilize bonds, that is another sign of pressure. The second sign is increasing interest in alternative trade settlements, because when large countries start trading energy, metals, or strategic goods outside of dollars, it signals a shift again. That does not destroy the dollar immediately, but it signals that the monopoly is weakening. The third sign is central banks accumulating gold and building alternative payment networks, because gold is the neutral asset, and alternative payment systems reduce dependence on dollar-based channels. The fourth sign is inflation becoming politically normalized, because when inflation becomes permanent, it often means the system is choosing currency weakening as the pressure release valve for the debt load. Now here is the twist, and this is important. Even if a reset happens, the system does not necessarily collapse completely. The system adapts. The powerful protect themselves, the rules change. The winners stay winners. And normal people either learn the new rules fast or they get crushed by them. So the real goal is not panic. The goal is awareness, because awareness prevents you from being emotionally manipulated by headlines and sudden policy changes. Now, in the next part, I want to bring it back home and explain what all of this means for your daily life. Because it is easy to talk about bonds, BRICS, the Fed, and global currencies. But the real question is, how does this affect your bank account, your job, your future, and your ability to build wealth? That is what we will cover next. Because once you understand how global money changes trickle down into everyday life, you will finally see why banks are not just businesses. They are the gatekeepers of your reality. Now let's bring all of this down from the big global level and make it personal. Because it is one thing to hear about banks creating money, central banks adjusting rates, governments issuing bonds, and countries trying to escape the dollar system. But it is another thing to understand how all of that ends up affecting you in ways that feel real and painful. Here is the uncomfortable truth. The money system is not just a background thing happening somewhere far away in Washington or on Wall Street. The money system shows up in your rent, your grocery bill, your interest rate, your job market, and the way your future feels either hopeful or stressful. The money system is like the operating system of modern life. And if the operating system updates, your life updates too, whether you asked for it or not. So what does a debt-based money system actually do to normal people? It creates a world where the easiest way to survive is to borrow, but the most expensive mistake you can make is borrowing the wrong way. That is why the average person ends up feeling trapped. You are constantly being pushed into debt, because the system markets debt like it is normal. You can finance anything. You can borrow for anything. You can turn almost any purchase into a monthly payment. In the short term, that feels like freedom, but in the long term, it turns your entire life into a spreadsheet full of obligations. Once that happens, it becomes harder to take risks, harder to change careers, harder to move, harder to build anything. Because you are not really living on your income anymore. You are living on what is left after you feed the debt machine. Now, let's talk about inflation. Because inflation is where people feel the system most directly. Inflation is not just prices going up. Inflation is your money quietly becoming weaker. Meaning even though the number in your bank account stays the same, the amount of real stuff your money can buy goes down. If you are a kid, think of it like this. Imagine you go to a candy store and your $1 used to buy 5 candies. Then one day your $1 only buys 3 candies, even though you still have the same dollar. You did not lose the dollar, but the dollar became less powerful. That is what inflation is. And in a system where money is constantly being created through loans and government borrowing, inflation becomes a constant risk. Because the easiest way to reduce the pain of huge debt piles is to weaken the currency over time. That makes the debt easier to carry, but it makes everyday life harder for regular people. This is why inflation feels like a hidden tax. Nobody votes for it directly. Nobody asks for it. But it drains buying power from your wallet anyway. Now, you might say, okay, but if inflation is so bad, why would anyone allow it? Because inflation is not equally bad for everyone. Inflation punishes savers and rewards borrowers, especially borrowers with big assets. When money gets weaker, the value of assets like real estate and stocks can rise. And the debt used to buy those assets becomes cheaper in real terms. This is why people who own assets often survive inflation better, while people who only hold cash feel like they are getting squeezed from both sides. That is the part that makes the system feel unfair. It can feel like the game is designed so that ownership protects you and cash makes you vulnerable. Now let's connect this to banks. Banks are the gatekeepers because banks control who gets access to cheap money. If you qualify for low-interest loans, you can buy assets and ride the waves. If you do not qualify, you pay higher rates, you rent longer, and you get squeezed harder. This is why credit scores matter so much in a debt-based money world. Your credit score is like your passport into better financial opportunities. And the system is not shy about this. It rewards people who already look safe and punishes people who look risky. Now, let's talk about the shrinking dollar idea. Because this is the part that connects global shifts back into everyday life. If the world begins reducing its demand for dollars over time, even slowly, the US can face more pressure inside its own economy. That pressure can show up as higher inflation, higher interest rates, or bigger shocks when crises hit. It can also show up as a slower standard of living, meaning you might feel like life costs more while wages do not rise fast enough. And this is how resets often happen for normal people. Not with fireworks, not with one dramatic headline. They happen with slow pressure. They happen with people saying, why does everything feel harder now? And why does my money not go as far as it used to? And why do I need to incomes for the same lifestyle my parents had with one income? That is a reset in real life. Now I want to be clear. because this video is not here to make you hopeless. This video is here to make you aware, because awareness changes behavior. When you understand the system, you stop trusting it blindly, but you also stop fearing it like a mystery monster under the bed. You can learn the patterns and protect yourself, because the system does not care if you are confused, and it does not care if you are unprepared. So the smartest thing you can do is treat financial understanding like a life skill, because it literally is. Now, next, we are going to close this out by tying everything together in the simplest way possible. And I am going to explain the full bank money machine in one clean story from start to finish so that you can repeat it to someone else like it is. Common sense. Then we are going to end with the biggest question of all. If banks profit from debt-based money creation, what does the future look like? And what should you be watching for next? Alright, now we are going to take everything we talked about in this video and simplify it into one clean story, because if you can understand this story, you can explain the entire banking system to almost anyone, including the friend who says bro money is fake, but cannot explain why. So here is the money machine from start to finish in plain English. First, you have regular people and businesses who earn money by working, selling products, or providing services. That money gets deposited into banks because banks are where society stores money, pays bills, and moves money around. Most people think that means banks just hold money, but in reality, banks treat deposits like a resource they can use, because deposits give banks the ability to create loans and earn interest. Then the next step happens. Banks lend money. When banks lend money, they are not just handing out cash that already exists, because they do not have enough physical cash sitting around to cover everybody's deposits. Banks operate on fractional reserve principles, which means they only keep a fraction of deposits available for withdrawals, and they lend out the rest. That by itself already feels strange, because the depositor still sees their money in the account, even though a large portion of it has been lent out to somebody else. But modern banking goes even further than that, because many banks do not just lend deposits. When a bank approves a loan, it often creates brand new money digitally by crediting a borrower's account. The borrower now has spendable money, and this money did not exist before the loan was created. That is why people say banks create money out of thin air, because in a very real sense, loan creation is money creation. Now the borrower spends that loan money, and it moves through the economy. It becomes income for someone else. It becomes deposits in other banks, and those banks can create more loans. That is how the money supply grows without needing the government to physically print cash. The system expands money through credit, so the economy grows, and everyone thinks everything is fine, because spending is up, jobs are up, businesses are expanding, and asset prices are rising. But here is the hidden catch. The whole expansion is heavily dependent on borrowing. The money system becomes like a bicycle that must keep moving forward, because if lending slows down as sharply, new money creation slows down as sharply, and the economy starts to lose momentum. Now we bring in governments. Governments also need money, especially when they spend more than they collect in taxes, which happens often. When the government runs a deficit, it issues treasury bonds, which are basically IOUs that promise repayment with interest. These bonds are bought by banks, corporations, funds, and foreign countries. That is how government spending gets funded when taxes are not enough. Then the government spends that borrowed money into the economy. It pays workers, contractors, programs, and suppliers. And all of that money ends up back in the banking system again, because people deposit it and move it digitally. This is how government debt becomes part of the broader money machine. Now we bring in central banks, because this is the part most people do not truly grasp. Central banks, like the Federal Reserve, help stabilize the system by controlling the cost of borrowing through interest rates and by injecting liquidity during major crises. When central banks lower interest rates, borrowing becomes cheaper, lending expands, and the economy heats up. When central banks raise rates, borrowing becomes more expensive, lending slows down, and the economy cools down. That means central banks quietly control how easy or hard financial life feels, even though most people never pay attention to them until they feel it in their rent, mortgages, and job market. In a crisis, central banks can step in and buy assets like government bonds to inject money into the system. This creates liquidity, calms panic, and prevents bank failures. The problem is that this kind of intervention can also inflate asset prices, which is why it often looks like markets recover faster than regular people do. In other words, the rescue can stabilize the machine while leaving normal families still squeezed. Now zoom out globally, because the story gets even bigger. The US dollar became the global reserve currency, meaning a huge portion of global trade depends on dollars, especially major commodities like oil. That creates global demand for dollars. which supports US borrowing power and helps the US run massive deficits without collapsing, the way smaller countries would. Because the world needs dollars, the world holds dollars, and that demand gives the United States a unique advantage. However, some countries do not like being dependent on the dollar system, because dependence on the dollar also means dependence on U.S. influenced financial networks. That is why de-dollarization conversations exist, why countries experiment with alternative settlement systems, and why some nations increase gold reserves. It is not always about destroying the dollar. It is about reducing vulnerability. Now here is the final part of the story, and it explains why this machine feels so creepy. Because money is created through debt, the system tends to expand debt over time. When debt expands too fast, bubbles form. When bubbles pop, lending tightens. When lending tightens, the economy slows. When the economy slows, central banks intervene. When central banks intervene, asset owners often benefit first. Then the cycle repeats again. That is the boom and bust cycle. It is not random. It is not a surprise. It is the rhythm of debt-based money. So if you ever wondered why it feels like regular people keep working harder, but life keeps getting more expensive, it is because in a debt-based money system, money itself is constantly being reshaped. The value of your dollar changes, the cost of borrowing changes, and the rules of the game are always shifting based on the needs of the machine. Now here is the reason this matters. When you understand this full story, you stop seeing money as just a paycheck, and you start seeing money as a system of control, incentives, and flows. You realize that banks are not just businesses that store money. They are institutions that create money. You realize that governments do not just spend money. They borrow money into existence. You realize that central banks do not just study inflation. They control the financial temperature of society. And when you realize that, you stop being shocked when the system behaves the way it always behaves. Now in the final part, we are going to close this out with the most important question in the entire video. What comes next? Are we heading toward more debt, more inflation, more control, and more resets? Or is there a different path? I will also give you the exact comment question to drop below this video. That will spark a war in the comments. Because the money system is one of the few topics that makes everybody feel like they have been lied to. So next we are going to wrap this up, connect the future, and end strong. Alright, now we are at the end. And I want to bring this home in a way that actually matters. Because the point of this whole video was never to make you hate banks, or fear the government, or walk around thinking the economy is controlled by a secret underground room full of suits. The real point was to show you that the money system is not what most people think it is. And the reason that matters is because the future is going to reward the people who understand the system and punish the people who don't. If you only remember one thing from this entire video, let it be this. Modern money is not primarily created by printing cash. It is created by lending and borrowing, and that means the world runs on credit. That credit fuels growth, but it also creates instability. Because when credit expands too fast, you get bubbles. And when credit tightens too fast, you get crashes. That is why the system keeps cycling. And that is why the average person feels like financial life has become a constant struggle just to stay caught up. So when we talk about what comes next, we are not talking about one dramatic event where the dollar dies or the banks collapse, or the entire world resets overnight. What usually comes next in real life is more subtle than that. What comes next is that the pressure builds until something changes, and the change often looks like higher cost, tighter lending, and more tension between what people want and what the system is able to deliver. If the debt machine keeps expanding, then the money supply will keep expanding, and that means inflation will remain a long-term risk. If global demand for dollars slowly shifts over the next decade, then the US may lose some of the special easy mode advantage it has enjoyed for a long time. And that could mean higher borrowing costs and harder choices politically. If the world becomes more divided geopolitically, then money becomes more weaponized, which is why alternative trade systems, gold accumulation, and de-dollarization talk will keep growing, even if the dollar stays dominant for years. So the future is not guaranteed to be a collapse, but it is almost guaranteed to be more volatile. That volatility will create fear for people who are not prepared, but it will create opportunity for people who are prepared. Because the money system does not care about fairness, it cares about flows. And flows always create openings. Now, here is the part I want you to really listen to. Because this is the practical takeaway that actually helps. If the system rewards ownership, then your goal should not be to perfectly predict the next crisis. Your goal should be to position yourself so you survive crises and benefit from recoveries. That means focusing on building skills that keep income resilient, reducing high-interest consumer debt that traps you, and slowly building ownership in things that hold value over time. You do not have to be rich to think like this, because thinking like this is how people become rich in the first place. And if that sounds too motivational, let me put it in the simplest explain like you rate and way possible in a world where banks can create money by lending. You do not want to be the person who only borrows money to buy stuff that disappears. You want to be the person who borrows smart when it makes sense, saves when it makes sense, and owns things that grow when the system inflates itself. Because banks will always profit from interest. Governments will always lean on debt when money runs short. Central banks will always protect the system from collapse when things get scary. So instead of being shocked every time the machine does what the machine is designed to do, you can treat it like weather. You don't scream at the sky when it rains. You bring an umbrella. The same mindset is how you survive a debt-based economy. Because the cycle is not a mystery once you understand the mechanics. Now let me hit you with the biggest conspiracy-flavored thought to end this video. Because it is something people feel, but rarely put into words. The money system is not just numbers. It is influence. It is incentives. It is power. The ability to create money, control money, and access money cheaply is one of the most powerful advantages a person or institution can have. That is why banks are not just businesses. They are gatekeepers. That is why central banks feel like invisible government, because they control the financial difficulty setting of society. And that is why the average person feels like the game is unfair, because they are playing inside a system where the rules were written by people who benefit from them. But here is the good news. Once you understand the game, you stop getting emotionally played by it. That is when you start winning. So if this video helped you understand banking and money in a way school never explained, do me a quick favor and hit like and subscribe, because this channel is going to keep breaking down the hidden mechanics of money, the global economy, and the financial moves governments and institutions make behind the scenes. And I want to ask you a question that I already know is going to cause absolute chaos in the comments. Do you think banks should be allowed to create money through loans? Or should money creation be taken away from private banks completely? Drop your answer in the comments, because I want to see where people stand on this. And also because I already know half the comments are going to be people fighting like it's a UFC match. Thanks for watching, and I'll see you in the next one.